Have you ever stopped to think about how money flows everywhere? Like even in places you might not immediately think of. Every single business, big or small, charities, corner shops, they've all got money coming in, money going out, and someone, somewhere, is keeping track meticulously. Taking the deep dive, we're really going to pull back the curtain on accounting fundamentals. Think of it like we're decoding the secret language of business, our mission, to unpack what accounting really is, why it's absolutely critical for, well, basically every type of organization, and how it acts as this universal language for money and business. We've taken a foundational text on accounting principles and distilled it down to give you the essentials fast. We want to connect those core ideas to the real-world decisions that happen every single day. So when we talk about accounting, we're fundamentally talking about the financial pulse of an organization.
Yeah.
But what exactly is a business in this sense? Our source defines it pretty simply. An organization that gathers resources, inputs, right? Like materials, labor, that kind of thing, and processes them to provide goods or services, the outputs, to customers. And businesses, well, they come in just about every shape and size imaginable, don't they?
Absolutely. From, the little coffee shop down the street to huge multinational banks or even, say, a university or a hospital, they all fit that basic model.
Right. And from an accounting point of view, it's useful to group these businesses in a few ways.
Yeah.
It impacts how we track their finances. Like, first off, what's their main goal? Is it making a profit, like most companies?
Or is it a not-for-profit, like a charity that's focused purely on its mission?
Exactly. That basic objective changes everything about how you measure success, financially speaking. We also look at what they do. Are they selling services, maybe like a law firm or a consultant?
Or merchandising, selling physical goods like a supermarket or a clothing store.
Or are they actually manufacturing things, making the goods themselves? Even farming fits in there.
Right, different functions.
And then, really crucially, there are the three most common forms of ownership. These have huge implications, especially for the owners. First, you've got the sole proprietorship.
The classic one-person show.
Pretty much. Often small, maybe service-based. The owner gets all the profits, but, and this is key, they also absorb all the losses.
And they have unlimited personal liability. That's the big one.
Huge. It means their personal assets are on the line if the business gets into debt. Then you have a partnership.
2 or more owners. Often retail or service businesses again.
Right. And generally it's the same deal with liability, unlimited personal liability for the partners, usually based on some kind of agreement they've set up.
And this leads us to the third main type, the corporation, or sometimes called a share company.
Okay.
Now, this is where things get really interesting from a business structure perspective. Here, ownership is divided up into shares, little pieces of the company. And the company itself becomes a separate legal entity. It's like a legal person organized under the law.
A separate entity.
Exactly. And the absolute game changer here is limited liability.
Ah, okay. That sounds important.
It's fundamental to modern capitalism, really. It means the shareholders, the owners, are generally only liable for the amount they've invested. Their personal assets are protected if the company fails.
Wow. So that must have completely changed how business is done.
It absolutely did. Think about massive projects, railroads back in the day, or tech giants now. They need huge amounts of capital from many investors. Limited liability made that possible because it lowered the personal risk for each investor.
Right, I could see that. Without it, nobody would risk investing in big, potentially risky ventures.
Precisely. The global economy we see today, it just wouldn't exist in the same way without that concept.
So what's really striking then is that across all these different types, profit, nonprofit, big, small, service, manufacturing, sole trader, corporation, all of them,
Every single one.
needs to keep records of their financial activity.
It just immediately flags how universal, how essential accounting really is.
Okay, so if it's needed everywhere, what is accounting? Let's define it. Our source says it's the process of identifying, measuring, recording, classifying, communicating, and importantly, interpreting financial reports.
It's a whole chain of activities.
Yeah, like a 3-step flow almost. First, you identify an economic event. Something happened that affects the finances.
Like making a sale or paying a bill.
Right. Then you record it systematically. And finally, you communicate that information, usually through reports, to the people who need it.
The users, yeah.
And it's important here, isn't it, to distinguish accounting from just bookkeeping. People sometimes use them interchangeably.
They do, and it's a common mistake. Bookkeeping is absolutely vital, don't get me wrong. It's the meticulous clerical part, recording all those daily transactions. You could call it the data entry part. But accounting is much broader. It involves designing the whole system, preparing the financial reports, analyzing them, interpreting what they mean for the business. Accountants usually oversee the work of bookkeepers, taking that raw data and turning it into useful financial intelligence.
Got it. So bookkeeping is the how, accounting is the why, and what does it mean?
That's a good way to put it. And stepping back, you see why accounting is often called the language of business.
Right.
It really is an information system. Its main focus is quantitative financial information. You can look at it in a few ways, like our source suggests. One, it's a service activity. It provides that quantitative financial info people need for decisions.
Okay.
Two, it's descriptive and analytical. It takes this huge mass of raw transaction data and boils it down into significant interconnected financial reports.
Makes sense.
And three, it is fundamentally an information system. You have inputs, the raw data from transactions, processing, recording, classifying, summarizing, and outputs, the financial statements.